welcome. I'm Sumita Karir and you're watching Rush Hour on ET Now. So over the next half an hour, we get you the latest from global economy, politics, markets and business. Beginning the show with our lead story this evening, ladies and gentlemen, the world's second largest economy, China, has witnessed a lower than expected growth in the second quarter. China's economy grew at 6.3% at annual pace in the April to June quarter in the current financial year. The 6.3% GDP print for the second quarter marked a 0.8% pace of growth from the first quarter. In fact, the unemployment rate amongst young people was 21.3% in June, a new record again. And that's not all. According to reports, China's GDP is expected to slow even further in the coming months because of the slack in consumer demand and collapse in demand for Chinese exports in other economies as their post-pandemic recoveries lose momentum. And now to talk about the Chinese economy and its impact on the rest of the world and emerging economies, we're now joined by Arnab Das, who's the global market strategist EMEA Invesco. Arnab, thank you very much for joining us here on ET Now once again.
Thanks for having me. It's good to be here.
Right. So, Arnab, I want to ask you first, China's economic data, the June trade numbers showed a fall. You look at the GDP estimates, unemployment rate, weak exports, weak domestic demand amidst geopolitical tensions. That really paints a very worrying picture for China as it struggles to get its post-COVID recovery back on track. But can China now achieve its full-year growth target of around 5% for 2023?
I think they are headed in the right direction, and I guess it's clear that the rebound on reopening has been much less than expected and much less than in many other countries, especially in the West. And so I do think that puts some pressure on the 5% growth target, and I think the Chinese authorities and indeed the market is sort of well aware of it, right? I suppose what's happening is that the authorities are becoming more accepting of a somewhat lower growth rate because China's potential growth rate is probably declining, and not least because a demographic transition has advanced rapidly, and because I think it has to be said, what's happening in China, partly by design, is sort of the opposite of what's happened in much of the rest of the world, especially the Western world and the U.S. Right? In the West, we provided a lot of fiscal support during the pandemic. For households and for businesses that had to shut down, especially in the United States, right? And that's why we've had such a powerful, high growth, high inflation kind of rebound. And I think also a big part of the reason why labor markets are so tight in the West. Whereas in China, the lockdown was much more intensive. It was much more extensive, right? Because it lasted much longer and much more repeated. And there was much less government support in terms of fiscal transfers and much less in terms of monetary policy support as well. So I think therefore we're having, if you want to say, put it this way, a more sort of natural recovery after an extended period of lockdown, extended period of pressure on business, particularly small and medium-sized enterprises, small business, and on households. So whereas in the West, we've been running down excess savings, in China, they're probably, retaining excess savings and being more precautionary and, more cautious in their behavior. So I think that helps to explain why the recovery so far has been less than expected. I would say, today's number was less than expected, but a lot of the kind of higher frequency growth data had been pointing in that direction. So maybe it wasn't such a surprise on the day. I think it's the accumulation of this kind of signal of weak economic recovery relative to earlier expectations of a Western-style rebound that has been taking place over a period of time. Looking out longer term, growth is probably going to be lower than it was, but of course it's a much larger economy than it used to be in the days of near double-digit growth. So it's going to still be an important source of growth for the world economy, even as the growth rate slows down.
So even as the growth rates slow down, it will still be a source of support for the global economy considering its size. And in fact, Arnab, we've also been speaking to economists who've stated that disinflation, in fact, is the bigger worry in China. But looking at a global economy that's weakening will not really offer much support for China's struggling recovery, right? So how soon can recovery be expected and which sectors could offer some relief, some initial green shoots at least?
Well, look, I think first, I think it has to be said, the global economy is slowing down, but I think in a way, perhaps the more important thing is how resilient the actual, many parts of the world economy, including the U.S., including Western Europe, including many emerging markets, have been, considering how much monetary tightening there has been. So what's really slowing down is not particularly supportive for China's recovery is sort of global goods demand, right? Because we all binged, or maybe not all of us, but many of us around the world binged on goods, on exercise bikes, on durables, on electronics during the lockdown, because we had to be online, we wanted to be online, and we wanted to continue with life in that context, right? So there's a big binge in goods spending, which has now been replaced by services spending and experiences and revenge travel and whatever you want to say, right? Which is not the sort of thing, obviously, that China exports relative to goods. And so I think that is a source of headwind for the Chinese recovery. So the recovery that's going to occur in China is probably not going to come from net trade. It's possibly not going to come from real estate and from heavy investment, because China has sort of maxed out a lot of those things already, right? The property market is arguably overbuilt and overdeveloped, and maybe there's still some financial stresses to be resolved in that sector. And of course, there have been a lot of infrastructure programs, over the past decade and a half, right? So China has spent the last decade and a half roughly re-leveraging or leveraging up, while the Western world has been deleveraging. That's sort of flipping around. The Western world has been issuing a lot of public debt. The private sector had been deleveraging during the last decade and a half. That's why we had low growth and low inflation in the rest of the world. That's now reversed in the West, and China is in that mode. So where is the growth and where is the recovery in China going to come from? I think it's going to continue to come from consumption and services. It's going to be somewhat slower than we've been used to, somewhat slower than China has been used to, but maybe it'll be a somewhat more balanced and healthy and sustainable recovery for that reason. It also looks like the Chinese authorities are trying to once again encourage the private sector, encourage the tech sector, at least to some degree, within the new regulatory constraints that have been imposed in the last several years, before and indeed during the pandemic, right? So I would say, rather than expecting a big infrastructure burst, although there may well be some of that, and a big property investment push, although there may be some of that, the bigger picture here continues to be to rebalance the economy towards higher value added sectors and towards high tech, right? And that is probably what the authorities have in mind. It may not be as strong a support for, say, emerging markets as a whole as it has been, but maybe in a more selective way, right, for countries that are directly involved in those kinds of supply chains.
Right. So what's the near-term impact that you see for a market like India, perhaps, Arnab? And I'm going to bung in my next question here because we're completely out of time. I want to understand, as far as the policy stimulus is concerned, how much of a stimulus is possible at this point in time, considering the local government debt has only soared?
Well, so let me start with the stimulus, and maybe that's a way of leading into the rest of emerging markets, especially India. So I think they can stimulate, they can afford to stimulate to a meaningful degree, because the savings rate in China is very high, right? Everybody always talks about the debt, and I think that's correct. There has been a big buildup of debt, and they're clearly wanting to reduce the growth of that debt, deleverage to a meaningful extent as well. But the savings rate is very high, and central government debt is very low. So if they want to, they can stimulate significantly. But I think my sense is that they would rather have a healthier, more balanced, more sustainable growth rate from all points of view. So I think we are going to get stimulus. I think it is going to be meaningful, but I don't think it's going to be dramatic, right? So I think we should expect the recovery to continue, to be wholesome, maybe is a good word, but not to be extremely powerful and extremely supportive of the rest of the world. So I think the bigger picture here is that China, for many investors, is going to continue to offer some sense of diversification within the geopolitical and other constraints and tensions that there might be, right? And that is because the economy is going in the opposite direction, going upward still, from much of the rest of the global economy, particularly the US, the UK, and Western Europe, that need to continue to slow down in order to bring inflation under control. Now, what does all of this mean for India? I think India is still a relatively closed economy. Probably doesn't all this stuff directly doesn't make too much difference for India. What does matter is that India has an opportunity that it is starting to exploit, that it can really do a lot more to exploit, in my opinion, to really catch up to the rest of Asia by exploiting the movement around the world that's going on in supply chains, in technology, and in other sectors, partly for geopolitical reasons, also partly for economic reasons, right? Because China is no longer as low cost an economy to do business in as it used to be. It's a very efficient economy to do business in still, which is less the case with India. So I would say, if India steps up to the plate with policies that reduce the frictions in doing business in India, whether it's to make in India or for made in India types of exports of goods and services, India can really catch up a long way here. And that's what I'm hoping this government or the next one, whoever's elected or re-elected, will continue to do.
Right. All right, Arnab, thank you very much for your thoughts, for your perspective on what the economic data means, not just for China, but the overall world and, of course, Asia. But the word coming in from Arnab Das is the fact that gradually the recovery in China will be gradual, but of course, it's advantage India, at least for now. Moving